Hello and a warm welcome to Money Mind. It began as a health crisis, as a new and highly infectious virus started spreading around the world. And it became an economic crisis as governments locked down their economies and spent trillions of dollars in rescue packages. Now that in turn has sparked fears that the debt crisis will worsen, which could affect the global economy for many years to come. But before the COVID-19 pandemic, the world was already deep in debt. According to the International Monetary Fund, government debt in developed countries was $60 trillion before the outbreak. That's 105% of GDP. The IMF says that will rise to 66 trillion at the end of this year, or 122% of GDP. Many developed countries are among the most indebted economies in the world. Emerging and developing countries borrow less as a proportion of their GDP. But emerging markets with weak financial positions are at a greater risk of defaulting on their debts. They currently owe more than $8.4 trillion in foreign currency debt, or about 30% of the developing world's gross domestic product. This is the fourth debt crisis the world has seen in the past 5 decades. The first 3 caused massive downturns in economies across the world. The World Bank now says this wave could be worse than anything we've ever seen. At least 102 nations have already asked the International Monetary Fund for help. That's over half of the IMF's membership. In this special edition of the Money Mind Exchange, we're going to take a deep dive into the global debt crisis and what it means for Asia. In a special Money Mind panel today, will the COVID-19 pandemic exacerbate the global debt crisis? And how are we going to pay for it all? Plus, is there a way forward? Well, to join me right now in this panel, I have my guest today, Stephen Schwartz. He's Head of Sovereign Ratings for Asia Pacific at Fitch Ratings. Sanjay Mathur, he's Chief Economist for Southeast Asia and India from ANZ Bank, as well as James Cho, he's Chief Market Strategist, Southeast Asia for HSBC Private Banking. Gentlemen, welcome. It's good to see you all here today. Sanjay, I'm going to come straight to you for the first question. This coronavirus pandemic has threatened to open this Pandora's box of economic and financial problems because the debt was high even before COVID-19. So not everyone is going to experience the debt crisis in the same way, though, are they?
No, they won't. And that's a good starting point because the distribution of this debt is fairly uneven. Now, that said, there are a couple of things that every economy, every corporate is going to have to confront. The first is that we will have a growth shock, which is already there in some ways. But what's also important is we will have a shock to nominal debt. And that kind of makes it difficult from a debt to GDP perspective. The second is that we've had weaknesses in exchange rates, etc., and that's going to make servicing external debt more difficult. And then the third thing is, today, if you look, lending rates are higher than nominal growth in many, many economies.
The amount of debt that we're seeing added on the back of this pandemic, is there a real possibility here that some countries might even go into default here?
As a consequence of direct fiscal measures, we're going to see an increase in deficits of around 7% of GDP globally. And that's concentrated really among developed or advanced economies, where we expect the increase to be around 11% of GDP, and much lower increases in emerging markets. And in terms of your question about debt stress and default, we really see a difference between the higher rated emerging markets, the developed economies on the one hand, versus frontier markets. For us, that's typically the single B rating range of sovereign ratings. those countries, for example, here in Asia Pacific, and countries like Sri Lanka, Mongolia, Pakistan, they're losing market access in an environment like this, and they've got very high external debt payments coming due in the coming years.
And based on that point about the amount of debt stress that we're seeing, what about for countries in the Asia Pacific?
The biggest increase in the whole increase of debt is largely seen in the governments across the world, whether it's Asia or even the developed markets. And bear in mind that governments, when they increase debt, it's different from households and corporations, because governments sometime down the road can raise taxes to finance that debt. At the same time, governments can use their printing press to finance it as well. And if you take Japan's example, for instance, even in Japan, over the last 25 years or so, Japan have been having this problem of debt, and in some ways, they have been having almost zero interest rates for the last few decades. And even in that case, during that time, most of the debt is held by the Bank of Japan and also by institutions within Japan. And there was even no defaults of that sort. So in some ways, for countries and governments, there could be a situation in which default risk is actually fairly low.
Because COVID-19 hasn't disappeared, we don't have a vaccine yet, we're in uncharted waters here. So what kind of impact is there in terms of this debt crisis on the ability for countries to actually rebuild their economies?
We've seen massive stimulus programs coming out. In Singapore, we're looking at 20% of GDP, Malaysia 17%. So they're very big. But if you look at the scale of the shock and the duration of this kind of shock, so we're talking of contractions pretty much everywhere after the stimulus. That's the scale of the shock. The second thing, and we don't know, is exactly how social distancing, how people imbibe it, what sort of policies are there later on. And that really means that the services sector, which doesn't really go hand in hand with social distancing, is going to be under a lot of stress for a long period of time. And that means debt servicing for the sector is going to be truncated for a long period of time.
Stephen, would you agree with Sanjay there that there is this very real risk of long-term imbalances beginning to develop here?
This is an exogenous shock, the virus shock to world economic growth. We're going to be looking at the medium-term trajectory of debt. And for countries that went into the crisis with fiscal space and who have strong track records of unwinding the stimulus, we're likely to take a much more favorable view, and correspondingly debt stress and debt service on those kinds of economies will be better. Focusing on Asia, we've long highlighted that countries like Japan, India, and Malaysia had very little fiscal space going into this, but other emerging markets around the region, such as Indonesia, the Philippines, Thailand, had run very prudent fiscal policies for a number of years.
We're going to go for a break right now, but when we come back, the winners and the losers of the global debt crisis. Stay with us. Welcome back to a special Money Mind Exchange panel discussion where we're talking about the global debt crisis. Stephen, how critical it's going to be for emerging markets in terms of their response, in shaping the trajectory that we're going to see, at least in the medium term, and separating the winners and the losers here?
Many of these emerging markets are announcing very massive headline stimulus measures, but when you pare it back, the on-balance sheet measures are much less. That is, the above the line fiscal spending is less than some of those headline figures indicate. And that's because a lot of the stimulus is off balance sheet or quasi-fiscal in nature. More than in the past, emerging markets are relying on central bank programs, lending programs, in some cases, the outright purchase of government debt on the secondary market, or in the case of Indonesia, even on the primary market. That's something new, something we haven't seen and something that we'll be watching how that gets unwound over the medium term. But I should say for the Asia region, when you factor in China's expected economic growth this year, is coming out looking a little bit better than the rest of the world. We think that economic contraction across Asia as a whole will be minus 1.6% this year. That compares to the global contraction of minus 4.6. So in a relative sense, maybe Asia is looking a little better than the rest of the world right now.
What are the consequences of these measures, Sanjay, the measures that we're seeing governments taking?
The lower end services sector that's going to be impacted for a long period of time. And it's unclear as to how long governments can continue to provide wage subsidies. So unless we see that transition from these services into something else, we will have to confront with that situation. When you look at countries like Philippines, Indonesia, India, they have a different problem. You have a lot of people in the informal sector, and they will get displaced from their jobs. And putting them back into jobs could be a process that takes several years, really.
Developing nations, will they just be continuing to borrow in perpetuity here? And can they afford to do that?
The risk is really a buildup of foreign currency borrowing amongst corporations in emerging markets in dollars, and that could be a risk. But so far, I think it's still distributed. There hasn't been really a big systemic risk of sorts, but nevertheless, I think these are risks that one should watch out for. And therefore, the investors have to differentiate between the issuer in terms of its ability to raise debt, etc.
We know that the G20 bilateral debt relief agreement gives eligible low-income countries an additional short lifeline, of course, but the G20's appeal to those private creditors, that's an issue. To provide comparable relief, that's unnerved investors somewhat. So how can it really be managed effectively?
There's some reluctance among many eligible countries to take part in this initiative because they've worked very hard over decades to increase their capacity to access private capital markets. And they're certainly in this environment going to be cautious about anything that undermines all of that work they did to gain access. So it's a bit of a double-edged sword. On the one hand, it provides necessary relief to allow governments to focus on the urgent health needs, but they'll need to do it in a way that doesn't undermine their access to private capital markets. And that's the tug of war that we're seeing playing out right now in this initiative.
There's always this risk that the debt relief of one creditor may go to paying off the debt obligations of yet another creditor. Are you concerned about that at all in this scenario that we're seeing?
We haven't really gotten to that point as yet. When you get a debt relief, you either seek debt forgiveness from another creditor or you use those proceeds and extinguish one debt. The intention behind this is really to help companies that are facing trouble with COVID-19. Now, what is the termination point for this? Or what is the starting point? I mean, there are companies that were having trouble even before COVID-19. How do you sort of deal with that sort of moral hazard? There may be sectors that are not related or haven't been much impacted by COVID-19. So how do you segregate them? And these are real serious operational issues in any debt relief, debt forgiveness program.
How far do you think that private equity firms are going to be the drivers, perhaps, of what happens next here?
In a post-COVID world, we're going to get a more digital connected world. So definitely private equity companies that can invest in companies that can ride in a more digital trend will do very well in the years to come. And also another trend is that we're going into a world in which interest rates are going to be extremely low for longer. And that actually plays to the advantage of private equity because they use that debt to reorganize and invest in companies.
The One Belt, One Road initiative. Could this ongoing coronavirus pandemic be a moment of truth, in a sense, for this program and what it means for the region? Because you've got a lot of countries here who now have debt with China.
I think certain developments are actually moving in the right direction, such as even in China, they're introducing the digital currency, and that would actually help transactions and commerce along this one road, one belt strategy. But of course, there are technical problems in terms of projects, management, etc. So there will be reprioritization. There's going to be some slowdown of sorts, or even a pause. But I think over the long term, and of course right now, in fact, such a global infrastructure spending program is what the world needs to restart the world's economy.
If there's a silver lining from this crisis when it comes to Belt and Road, is that it puts the spotlight really on the commercial viability of many of these projects. To the extent that these were government to government and often had a geopolitical strategic objective, there was always the risk that these projects might saddle countries with high debt burdens that they simply couldn't repay. So we're certainly in the past few years, and even more so now, seeing greater scrutiny about the terms of the financing. We've seen pushback from countries like Malaysia or Sri Lanka in renegotiating the terms of their borrowing, and greater focus in China among creditors about lending for projects that really have high rates of expected return over the medium term.
It's time for us another break, but when we come back, the road ahead, is there a road to recovery? Stay with us. Welcome back to a special Money Mind Exchange panel discussion where we are talking about the global debt crisis and the future ahead. Is there a road to recovery? So today's crisis is being viewed almost as a temporary event. That is the assumption. But we have weak global growth. We had it even before the pandemic began. That hasn't been solved. We had another set of concerns which have just been exacerbated. So how urgent is it here now to address this?
Well, on the one hand, the plunge in growth and the economic contractions that we're seeing certainly as a temporary element. We expect growth momentum around most of the region to return to positive figures in the second half of the year. So one of the critical questions, it's something that I don't think any of us has really yet come to terms with. We're seeing tremendous hit to private investment, the rise in the public debt burden. Does this mean that medium-term growth potential in some of the rapidly growing emerging markets such as India or China will be hit over the longer term? If the answer to that is yes, then it's certainly going to make it much harder for economies to grow out of the debt burdens that are being accumulated as we speak. And we are increasingly concerned that medium-term growth potential might have been permanently hit by this crisis.
So let's talk about the significance of multilateral cooperation for global recovery. We've seen this activation and establishment of swap lines between the US Federal Reserve and many big banks, central banks and so on. It has helped to ease shortages for international liquidity. Do you think this should be extended to other countries as well?
Well, I think in terms of policy coordination, what we've seen is it's a mixed bag. In terms of central bank coordination, we are seeing a very strong policy coordination, particularly when the Federal Reserve allowed the swap lines to other central banks, especially when there was a dollar shortage during March. And since then, they have created swap lines, repo facilities to help tide through or ease that dollar shortages in other financial markets. And I think the policy response from the central banks in some way provided that backstop for the world economy. But of course, in terms of fiscal policy, we see a very strong fiscal response across all governments. But in terms of coordination globally, I think that's still, the verdict is still to be out.
Because this debt crisis is also a humanitarian crisis. It's a global public policy crisis as well. How concerned are you of the risk that, depending on how countries fiscally manage this pandemic and emerge from it, that could trigger any kind of social unrest and in that scenario, further delay economic recovery?
I think that is a significant risk. I would say that in the Asia region, it's less of a risk, partly because we've got much more greater fiscal flexibility to deal with these sort of issues. But once you, even within Asia, once you sort of move towards the lower income countries, you do have a problem. You move to countries which have largely informal sectors, you cannot rule that risk out immediately. You have sectors which have sort of unorganized manufacturing where there's very little labor protection, you do carry that risk. So these are issues. They are going to be flashpoints. I wouldn't want to necessarily say that they will lead to unrest, but they will definitely have political repercussions.
Because even when this pandemic is over, even if an effective vaccine or a therapy is found, the global economic recovery is not going to be a straight line. We accept that, right? So what are the hurdles that remain that could put a cloud on this road to recovery or create a silver lining for it? And Stephen, I'd like to begin with you.
One is, what is the impact on medium-term growth potential? The hit to private investment, the tremendous dislocation, the spikes up in unemployment rates. It's very hard to envisage, a pure V-shaped recovery after a shock of this depth and magnitude and even now duration. And so that will be one hurdle, how to restore medium-term growth and productivity that you alluded to earlier. And the second will be how to unwind all of this stimulus without creating new crises and new problems. A return to medium-term fiscal consolidation plans, an unwinding of the central bank purchase programs, the risk that if longer-term interest rates rise, as is happening right now, what kind of impact that might put on borrowing costs and frustrate the return to medium-term consolidation.
One of the problems in the Asia context, two of the fastest growing economies are India and China. They have been. And now you start to see a region that's slowing down or is gone into sort of slower growth, even with relatively favorable demographics. And that to me is really the biggest sort of challenge we have. And how do you manage public policy at that point in time?
Well, I think by and large, what has happened in this world is that economic potential has declined. So consumers would spend much lesser than in the pre-COVID world, as well as corporations. They're going to invest lesser. But there is a silver lining in that it's going to be a more digital world, in that consumption patterns would shift more online. So there are opportunities in that space.
We'll take that, James. Thank you very much, gentlemen, for your perspectives and insights on this topic today. I've been speaking to Stephen Schwartz. He's head of sovereign ratings for the Asia Pacific Fitch Ratings. Sanjay Mathur, chief economist for Southeast Asia and India from ANZ Bank. And last but not least, James Cho, chief market strategist Southeast Asia for HSBC Private Banking. Thank you all for your time today. You've been watching a very special edition of the Money Minded Exchange panel conducted remotely on the global debt crisis. Take care, stay safe, bye for now.